I mean, Powell has beat us over the head with the idea that it's really more about employment now than inflation, or at least employment as a part of inflation. John Najarian, looking at the options pits, options markets, anything that people are doing with the SPY, the S&P 500, that giving you into your crystal ball some indication of which way they are macro betting on this market?
Yeah, Brian. In fact, there are. Just fresh from today, they're buying the 463 calls in the SPY. They bought about 22,000 of those. So that's an upside bet from where we are right now. I'd love to be as optimistic as Surratt as far as, positive jobs report Friday. I don't think it'll be that, Surratt, mainly because we don't roll off for the enhanced unemployment benefits until September 6th. So I don't think as many people will be going back to work in this time frame as I believe they will in the next one, Brian. And that, of course, won't really impact because we don't have an October meeting for the Fed. We've got September 22nd. Then we've got November and December. So they could do a meeting. Of course, they could do an emergency move in between meetings, but there's nothing scheduled. So I think a soft jobs report this Friday is what we're going to get. I think that's why some of the people are sniffing that out, buying upside calls, because they believe that keeps the Fed on the sidelines a little bit longer.
And the Fed's clearly going to wait until after the extended benefits roll off in September, and then you got to give it a month or two to see that data coming through. To your point, John, it could be Christmas or early 2022 before we start to get jobs data that the Fed may actually start to pay attention to. All right, Joe, going back to the markets and what to do. There's this book called Buy High, Sell High, or Sell High, or whatever it is, tremendously written. You don't have to buy low, you can buy high but sell higher. Is that kind of the way you see this? Just a grinding, 52 record highs for the S&P 500 this year?
I do. I think Steve made an excellent point where the market continues to rotate. There are corrections, but when those corrections are occurring, the market is rotating. Capital is finding other places in the equity market. To get a sustained 5% decline in the index itself, you have to see capital flow in the entirety out of equities and find a home somewhere else. That's not the environment we're in now. And Brian, let's remember something. Just because we will be tapering, and I believe we will, it is not automatic that we'll be tightening thereafter. The two of those, they do not need to have a simultaneous occurrence. Last time we tapered, which ended in October of 2014, we began tightening 13 months later. Well, Brian, did we ever really tighten? Because back in 2019, we were reversing the tightening and we were beginning to lower rates once again. So I think investors need to keep that possibility in mind that we might taper and growth might not actually be strong enough to really get into a tightening mode for rates.